Okay, folks, welcome back. We're going to be doing a continuation of the algorithmic order flow. Changes in the state of deliveries is part 2. All right, so we have our chart trained on the daily chart of the euro dollar. And we were talking in the previous lesson how we started our buy program right in here. And whenever we're starting a buy program, we want to be considering where it could trade to. So we're going to be working inside the range. So if we're working at a beginning point here and we're bullish, we have to consider this high to this low and where we're at in terms of the range. So we are extremely oversold without needing to have any overbought oversold indicator relative to this price point in here to here. If this was a box, if you will, we're in the lower end of that box. So we're very suppressed in terms of valuation, and it's considered cheap. So the algorithm has multiple price points in here it could trade to. From here, it could trade from here to there, and that would be the end of it in some instances. Or it could trade from here to here, or from here all the way back up into and above this high. Now I'm going to count you to go back and look at the commentaries around this time period because we were looking for higher prices anyway, and I gave you an idea how if I was making the market I would take it down below here and then start setting it higher up into the levels I mentioned in those recordings and in the previous lesson. We're going to counsel you to study this range high to this low, okay? And I want you to think about some of the lessons that you've learned in the core content. Now, I'm going to say some things here that may not have been covered yet by the month that you're at right now. So what do I mean by that? You may not have gotten to the levels of lessons and content and principles and concepts that I cover that I'm going to just go over here and in passing. In other words, I'm taking a lot of liberty and assuming that you are already familiar with this lesson. This is one of those lessons that you will understand more when you see the other lessons that teach more about the principles I'm going to cover here, okay? I want you to think about how this works together and how, from an algorithmic standpoint, the delivery of price is facilitated. Now, that's just a whole lot of mumbo jumbo for saying this is how your charts make the candles. Okay, it's a little bit easier to say it that way, but I'm giving you the inside track as to what's actually going on. But in layman's terms, this is how the market goes from where it is and where it's going. All right, so we're oversold here relative to the range high and low. We're down in the lower end. We framed out the likelihood of bullishness on euro, bearishness on dollar, and we could likely see price trade all the way up to and above this high. Now, what happens if we don't trade above the high? Well, that's fine. We have a PD array that works with that. That's the rejection block here, the highest up close. Okay, so we'll refer to that. We're going to refer to the last up close candle as the bearish order block and the mean threshold of that range. Okay, so with that in mind, we're going to be considering how, if this is the beginning, and we're going to use the rejection block because we're going to assume that it might not go back above this high. It could fail. So how do you frame probabilities around that and still find opportunities that don't require you knowing, because you're developing, you don't know for certain if it's going to take that high out. But what if it trades to that rejection block? Isn't that a handsome objective? Sure it is. What happens if it trades just to the mean threshold of that up close candle? Sure, that's amazing. How about just to the bottom end of that up close candle? It's fine just as well. So you have to look at where you are, and we're assuming we're trading here with the benefit of hindsight only for this lesson. But again, go back and watch the lessons and commentaries back then, and you'll actually hear me talking about how we're bullish there. Okay, so we're looking for the 3 PD arrays that are premium by nature. That means they are PD arrays above the market price down here if we're underlyingly bullish. as it is. In this example, we're going along with what we were looking for at the time. But I'm going to flesh out a few things here and ring in some things as well, so you can see how the algorithmic order flow works in concert with IPTA's PD arrays. So from here up to here, we're working with a bullish bias. So let's study how we can forecast likely areas where IPTA will create a change in the state of delivery. And how do we do that? Well, I teach you a concept in this mentorship called grading a price swing. And the yahoos all over the internet that are trying to make a name for themselves with my content or just credit me, they're trying to say that it's quarters theory, and it's not quarters theory. If you study quarters theory, you'll quickly see that what I'm showing you is not quarters theory. Quarters theory doesn't understand how we use the range low up to a range high, and then we split that in 25, 50, 75, and then terminus. Understanding that the IPTA PD arrays will have logical levels where we can anticipate and forecast before the price creates the buying opportunity when we're bullish. So again, if you think that this is quarters theory because you haven't got that far in the mentorship, I'm going to counsel you to revisit that while we're on holiday break, and then come back to this and remember that when we go into the teachings in the core content with my ICT grading the price swing. Okay, so we're forecasting a price move higher. So if we're thinking it's going to go to the rejection block, which is what I'm going to use in this example, it could just as well as been the mean threshold or the bottom of the bearish order block. That could be your terminus. That's the end of where you think it's going to go. That's like the safe bet, the bottom of the bearish order block. Mean threshold is a medium type target or objective for terminus. And then rejection block is just to make sure you try to get the best of the move without running out the high. Okay. Now, again, we were looking for this move here anyway, but we're going to err on the side of caution and show you how you can frame it with using the rejection block and not anticipating, obviously we were expecting, but not anticipating the run above the old high, because there's many times that price will fail to go above an old high, but many times it'll go right to the rejection block and offer you the ideal exit. So you have to frame with experience. There's no real science to it, folks. That part is an experience thing. It's a knack that you get over decades of doing it. Now that's going to sound like, oh, come on, I need a silver bullet, Michael. What I'm going to show you here is enough, and you'll see quickly that it's plenty of opportunity. So with this range in mind, I'm going to add the grades of my price swing from here up to the rejection block. Let's do that now. So here is the buy program, and here is the first grade at 25%, 50% grade, 75% grade, and then finally terminus here at the rejection block. Now on this time frame, it's not terribly interesting, but if we drop back down into that 4-hour chart as we were looking at in our last slide in the previous lesson, let's do that now. All right, so we have our chart trained in on the 4-hour chart for Euro, and again we're assuming that this is the beginning of the buy program, and then we have the market breaking market structure here, and then we create an imbalance right there. So that's a buy side imbalance, sell side inefficiency. So when it goes above this high, that is a change in the state of delivery. What is it doing? It's running to buy side liquidity, then it runs up, fails to get above this high here, but then trades lower back into the imbalance here and back into this area of old order flow. This is your breaker. It trades down to it here, but we can anticipate a new buying opportunity in and around that 25% grade. Okay, so all I did was taking a fib from the low here up to the projected rejection block. So that's the range I'm working within. It's an unrealized range. In other words, at this point here or even here, it hasn't traded there. And even in this example in Fractal, you can see that it didn't actually trade up to the rejection block. It went to the mean threshold And then here's the bottom level or low of that bearish order block on the daily chart. So there's our three levels here, 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 and here. So you can see how the market traded respectively. But look what's happening a little bit closer. When the market retraces lower back into this old area order flow and comes back in contact with a bullish order block in the form of a breaker, that's this last up close candle. It's filling in this imbalance here, trades down to it here, and then what does it do? It changes its state of delivery. What is it changing to? A run on buy side. Whereas it was running here on sell side, it hits a level that would constitute a potential change in the state of delivery. Why? It's mitigating at that price point because breakers are mitigation. What does that mean? Anything that was held short from here that was not taken off prior to this run here, institutions will be allowed or permitted the opportunity to mitigate that loss. Now, they may not get out even. They may not make a profit. It's not important for that to occur. It's just to reduce the overall exposure and risk and clear their positions at as close as they possibly can to the point at which that would be the minimal, not exiting their positions at a maximum loss or while it's running away from them. So we have mitigation here after rebalancing the buy side imbalance here with the bullish breaker. Once it hits that, then we can anticipate. Now here's where tape reading comes in. When I look at things like this, and it happens on a 1 minute chart the same way, folks. It's not just a 4-hour chart. It's a phenomenon that repeats over and over again once you understand what the draw on liquidity is. The assumption in this example here, in this teaching, is the rejection block is the draw. Now, I had the benefit of having hindsight in front of me, and still with the hindsight benefit, I did not frame it where I used the best example with the rejection block getting the high. But with the mean threshold of the bearish order block, look at the bodies of the candles respecting that mean threshold. And in this darker line here, extend that out in time, that's just the bottom end of the bearish order block or the low. Okay, so you can see there's the difference between all three of those PD arrays. But using the draw on liquidity that would be ran to, which eventually it was, but not in this study, it did get to the rejection block and went higher, obviously. But as long as it's moving in that direction, that's order flow. Okay, we're staying with that narrative until something obviously tells us differently. It ain't going to go there. But 25% of that grade, what does that mean? From the low up to that rejection block, we split this up into equal parts, and you do that with a fib. And the way you can do it without having to fancy dance your fib is do a low to the rejection, find the 50% level, and draw that out here. Then pull your fib from the low up to this level here, and then it'll create a higher 50% level, which will be right there. Then drop a line there, and then drag that fib back down, and then pull it from the rejection block to here, to this 50%. And what that'll do is give you a halfway point between this level and the low, and that'll be here. So 25 is 50% of this and this. 50 is half of this low and the rejection block. And 75 is half of the midpoint or half of the projected range from low to rejection block. High or rejection block to midpoint, you'll get to 75%. Okay, so there's your grading of a price swing. Now by itself, you know, people see this and what I'm about to show you, and their jaws drop. They're like, wow, this is crazy. You will not know how to do this by watching just this video. You need all the mentorship for you to know this. And you can see by watching my analysis and what we were expecting for Euro, how all this dovetails together. So at the 25%, we see price trading down below it after it trades above it. Trades to a bullish breaker here. And then we have what? Displacement. We have an imbalance right there. And notice it goes here and starts to trade back down at the 25% grade and it goes into consequent encroachment of this buy side imbalance, sell side inefficiency. At this point here, has it fully taken buy side liquidity out? No, it hasn't even gone above this high yet, nor has it gone above this high, leaving relative equal highs. So when this retraces down like that, we are not looking at this to completely collapse. We're looking for it to come back down into this buy side imbalance, sell side inefficiency. So what's happening here? The buy side is changing its state to sell side, going into an old imbalance where it was buy side previously. So what is this lesson showing you? It's the changing of the state of delivery. This is where the opportunities form algorithmically. The buy side here, in other words, basically think of it like this. I'm going to try to talk where we're just talking about up and down. All right. Think about that paint roller analogy I use all the time. When the paint is distributed on the up roll on your wall, price is being offered on the upside. But at some point, it's going to need to come back down to rebalance areas where the paint didn't really go well on the wall. There'll be little pockets there where the paint wasn't evenly distributed. That's what's happening here. So they're rolling that paint roller back down on the canvas of this chart, only to get to an area where there was richer delivery of paint with this candle here. When it happens, once it does that, that change in the state of delivery sets up the opportunity for new buying, because it's filled in an imbalance, and also it's occurring around 25% of the grade of the forecasted price range that should deliver. We don't know, like we're showing here, we don't know for certain it's going to hit this before it goes lower. We don't know that, but it's not necessary for it to hit that to find opportunities. Watch what I mean by that. So we have a mean threshold buy side imbalance at 25% grade and buy side liquidity left intact. So we know the price is going to be strongly pulled to the upside. It does in the next candle here. Runs up above it, consolidates. Are we anticipating it failing after it goes above these highs? No. Why? Because our analysis is saying that the draw liquidity is up here. So we don't look at all this in here as, oh, it's going to run above equal highs and then break down lower, like everybody on YouTube thinks. You can talk like me and have things on your chart, but you have to know why I think the market's going where it's going. That's what differentiates us from people that just have a casual exposure to what I teach. So the market does what? It rallies again above this high. Now watch what's happening, folks. This is important. The market trades above this candle's high right there. And immediately it does what? It has a change in the state of delivery. What is it doing? It's offering sell side again. It's going down. What is it doing? Is it coming all the way back down here to run this low out? No, it's not necessary, because this low has done something at that 25% grade. It rebalanced and then expanded up and ran buy side liquidity. Not fully running to this level up here yet, or even close to it. So when it starts to dip back down in here, what are we looking for? It's running back into old area order flow, which is this last down close candle right there. Okay, this down close candle right there is a propulsion candle. The market trades back down into this candle here and creates an additional propulsion candle, which is bullish, basically trading down into a previous down close candle. So what we're seeing here and what we're expecting is bullish institutional order flow. That means all down close candles, if they trade back down into them, they should support price and go higher. Every up close candle, which we don't have anything over here in this part of the price action, but if you scroll back, you want to see how price runs through old up close candles, which is breaking bearish order blocks. Okay, again, it's not every up close candle in a swing high makes a bearish order block, not for a short. Sometimes it's just a way of measuring order flow. And what I just dropped there was a heavy piece, so make sure that gets in your notes, because you'll hear more about it when you get into charter membership. But we have the market trading at this level here at the order block, and propulsion candle, another propulsion candle, and then rallies up, creates an imbalance right here. Now, notice what's occurring here, folks. This is one of those aha moments. So this imbalance here, does it need to be rebalanced? In other words, does it need to see price come back down here? No. And here's why. Here's where algorithmic theory comes in. At the 50% grade of the potential price swing that we're forecasting, this is generally where we consolidate. It can consolidate longer than it did here and just run out a short-term low or altogether continue. This is where we generally see a run on stops at about the 50% level. If there's an imbalance, they tend to leave those imbalances open. Now again, I just dropped something very heavy. Why would they want to leave an imbalance here just below the 50% level or 50% grade of the projected price swing that we're looking at? Because this is going to act as a breakaway gap or measuring gap. You want to see these things left in price. Now, if you think about how sometimes in my commentaries I'll say, it's better if they leave this area open and don't rebalance it. Oh, light bulbs are kicking off now. Yeah, we're getting to the good stuff. This imbalance should be left intact when we get close to that 50%. Now, if there is no imbalance and there's a short-term low, then around that 50% level, we could anticipate it dropping down below a short-term low, which could have been easily this one, and then that would be a buying opportunity. But if we have an imbalance below the 50% level, I tend to like to see these stay open. Now, that does not mean that it's always the case. Sometimes it will trade back down there. But if it does, I'll buy in there. I'll take a buy in that, okay? But from an algorithmic standpoint, it's better for it to stay open because it will act as a measuring gap or a breakaway gap. And you learn more about that as well. Okay, so around the 50% grade, it consolidates. You can clearly see that. And then we have another expansion. What are we seeing here? Another imbalance. These will not want to fill. Just like this one down here, we have one here. It's close to the 50% grade. They will act as breakaway gaps. In other words, it's signifying strength on the upside. You want to see these remain open. And again, I'm going to counsel you to think about how many times you've heard me in my commentary say it would be better if they left it open. And then they many times stay like that. And they'll obviously fill at a later time, but not before it trades to where we think it's going to go. You see that? So think, what I'm showing you right now already isn't anywhere in books. It's not in any books on gaps. It's not anywhere in the idea that guy created in 2012, the quarters theory. Okay, this is not quarters theory. I'm giving you highly specific things here that are algorithmic that repeat because it's based on the delivery of price. Period. Okay, these things tend to repeat if you are accurate with your analysis projecting a forecasted run like that. That's why I'm saying it's going to take you experience to get there. And that's why I lend my experience in my commentaries. So every time I point to something, if I think, okay, this is where the market's most likely to draw to, these are the types of things you're supposed to be doing. I'm not going to do this for you. Now, if you go back and watch the videos, all these things will start matching up and you'll see why I'm saying certain things and why I'm not saying things about other order blocks. Because I get a lot of questions about, well, why didn't it go down here? I was waiting for it to trade back down here because look, ICT has 2 down close candles. That's a consecutive down close candle in an 8-hour chart if we were looking at, because this is a 4-hour time frame. And we have an imbalance here. So I was expecting it to trade back down there, and that would be a high probability order block to buy. And I'm frustrated because it doesn't go down there. Your understanding is increasing now with this lesson. Now imagine your first month here and your first week in this mentorship, and I hit you with a lesson like this one. You're going to be like, what in the world are you talking about? This is contrived. It's all made up. This is hindsight trickery. You're conning us, Michael. But you're looking at price action that we were looking at before it happened. And I'm also referring to points in your core content that, like I said, over time, I'll pull on that information that you've learned and hopefully have taken notes, and you'll start seeing how my mind sees these things, and I pull on them for reference. So if the logic is true, it will repeat. If it's repeating and it's true, then my analysis should be strong. My analysis is strong. All of these things I lean on. They're not found in books. There's no algorithmic book out there that teaches this stuff. I promise you, it does not teach it. And if you want to spend all the money out there chasing all that stuff, go right ahead and you'll regret having done so. But just remember, I warned you. It's not out there. This stuff I'm revealing for the first time right here. In this mentorship, this is the first time I've ever divulged any of it. The 50% level of a price grade from an unrealized price run or price swing, this is an area where consolidation can occur. We talked about in previous lessons recently about how some of you were concerned about when can I anticipate consolidation? Well, here's where it usually takes place, around equilibrium. It could spend time in here and then make a false run and then go down below a short-term low. That's something that can also happen. Okay, it can create a breaker forming and then come back down to that breaker later on and use that as a buying opportunity. But we have another order block here. It trades down into it. Are we anticipating it running deck down into this area here? No, because we're grading the price swing. These areas is where the market's going to refer to and reference its delivery. And in the imbalances, and every one of these order blocks are within a smaller price range. And you can study all of this on a 1 and 5 minute chart, and it can be an amazing study there as well. I'll leave that for your homework and let you find your own things there. But the market does not need to trade back down here or here into this imbalance. Once we get to the 75% grade, it runs almost to the mean threshold of the bearish order block, which is this level here. But it comes back down and does what? It runs into the order block here. All these down closed candles, it trades into that and runs sell side liquidity out. Some of the instances that you're going to see, there is not usually a stop run around that 75% grade. Usually it's just a real quick run to the target. If it does run the stops, then the next price leg that's going, you need to stay with that. And if you're in a trade like this, you would aggressively trail your stop loss, because it's done a stop run here. And if it does fail to get to your target, once it returns, then it will probably seek out areas like this, because we've taken two targets. We have the bearish order block low here, which is a premium array, mean threshold of the bearish order block on a daily chart, which is here. And look at the bodies of the candles respecting that. Yeah, we get a little bit of a spike through it here and a couple little wicks through there. But overall, look at the volume. You don't think that that's being controlled, folks? It's absolute evidence of being controlled. This is just manipulation reaching for the best case exits. That's broker based. But this is the bulk of the volume. That is coming directly piped in from the central bank. It's absolutely controlled. Also, we're running above an old high here. So it's another area of distribution where they're going to do offset distribution of accumulated longs in here, 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 and here. And what I just said, again, if you're not that far in the mentorship, trust me, it's covered. It's not entirely exposed and taught yet, but I introduce more concepts around it. But I'm pulling these things together. This is why I tell you all that there's no way for me to take almost 3 decades of information and understanding and can just press it into a couple videos and you think you can watch that and walk away and know what you're doing. It's absolutely impossible. Like, I wish I could do it and then my job's done. Then I can go about my normal daily life and everything's easy. But it's just a lot of unpacking to do, and you can see how all this stuff works beautifully together. You can forecast buying opportunities around the 50, the 25, and the 75. You're forecasting that. Before it ever gets there, you can anticipate that there's going to be a buying opportunity. And I'm giving you rules about where and what grade offers what type of condition. 50% is usually consolidation. If there's an imbalance below it, it tends to stay open. That's the best case scenario. It can fill it, but if it does go down there, you buy it. 75 tends not to have a sell stop run. It tends to consolidate, create a optimal trade entry type event, and then run to the target. So I could have given you an opportunity where we're giving you the best case scenario using the mean threshold, but I gave you this as a draw on liquidity. Now watch what happens when it creates this point here and then rallies. You're trailing your stop loss all the way through here. Once it gets above the mean threshold, your stop loss is in anywhere in this area here. So what are you looking for then? You want to see it run higher. But if it starts to break down, you're going to get stopped out. Why? Because if it's going to break down in here, it's going to attack the sell side liquidity resting below here. The market breaks down, takes the sell side liquidity out right there. So if your stop loss is trailed here, you gave up all of this paper profit that hasn't been, it's basically unrealized profit. So if you have a live trade on, which you're not supposed to have while you're in mentorship, but if you have a trade on in demo, these profits will be eroded and then they'll attack here. So it's taking you out at a less favorable position exit than that of being stopped out here, because you're trailing it. Once it gets above this high here and we're at the mean threshold of that daily bearish order block, you have to be cognizant of that and thinking, okay, as much as I want this rejection block to be traded to, I might not be right. So you want to manage your stop appropriately with that in mind, because that could be the catalyst for you getting stopped out and giving up all of this here, which is basically a full 100 pip price range. But once it takes out this level here, watch this unrealized rejection block. When this high here, we come back down into the 75% grade of the price swing. Has that objective been met yet? No. So we're trading back down below this low right there. Think about the rules I just gave you. 75% grade generally sees no run on stops. But if it does run the stops, you can use that as a buying opportunity. So you can be buying below here in these down close candles. Order block, sell side liquidity, unrealized objective in a PD array. Nothing really hasn't broken down. Like, this isn't technically a break in market structure. It's just a run on stops. Order flow is bullish. So you could be a buyer in here. Market creates a deeper run into the order block. Consolidation. Look what's consolidating around 75% grade. And then off to the races again. And then all the way up here. So in perspective, you're seeing the buy program start down here and just a run to this. This is how you start finding consistency. It's not trying to buy it here and hold it up to here. You got to look at every price range. From here and here, there's your range to work within. From here to here, that's a range to work within. From here to here, there's 3 ranges to work in. Experience will dictate which one you work with. I took your attention here initially, and I said that I believe around Christmas time, we will be above here. And well, we were, because this is the week of Christmas. In fact, it's the day after, and we're even higher than that. So this lesson highlights the repeating phenomenon around algorithmic theory. Repeating phenomenon is not every time. Okay, it's just the majority of the time, these are the things I'm looking for. These are the things I'm looking for in price action. If I'm watching a price action move on a 1-minute chart and I'm trying to trade inside that range for the session, I will treat this low and this high at, say, for instance, how can I say it? Like, say this is the high of London, and we traded down into New York, and say this is not a daily chart. Okay, say this is like a 15-minute time frame. Okay, I could work within the range from this low to this high on a 15-minute time frame, and then work with a 1-minute chart, doing everything I just showed you here with a 1-minute chart. I would grade the price swing with this framework here on a 15-minute time frame, and I'll work around all of that if my bias suggests that this is a likely run to take out the London high. So it's not just applicable to 4-hour charts for long-term position trading or swing trading. It can be scaled down to micro market structure and trading 1-minute charts. And when you start studying that, and there's a plethora of opportunities for you to study using a 1-minute and 5-minute chart. All you have to do is go back and look at your session highs and session lows and think about how we were bullish or bearish during that time and study with that context, and your charts will look entirely different to you then. They will start telling you a story that's been hidden from you all this time. But you cannot appreciate it or find it with me just talking about it like here. I'm giving you the way or the process to start seeing it for yourself. But you have to go in, and you go into the charts digging in. You take your pickaxe, your shovel, and you put your miner's cap on, and you get in there and you just start digging around using the things I teach you. And then something magical happens, okay? It sounds comical to the cynics, but after a period of time, and I don't know how much time, once you spend enough time doing this for you, you will start seeing things that make sense to you. And everything that I'm saying that may seem like it's a different language sometimes, or it's like, I wish he would just get to the point or say what he's trying to say. I'm saying exactly what I want to say. You just aren't where you need to be able to see what I'm saying in the chart because you haven't spent enough time digging around. You're just looking at my examples. So something will happen where it'll click. Then you'll start seeing it with a perception that you didn't have before. It doesn't mean you're going to start trading with 100% or even 90%. It just means that you're going to start seeing things in charts more clearly. And then that's another milestone. And it's very exciting when that happens, because then you start forecasting where price action moves are going to occur. Think about it. If you can grade the price swings like this, you can forecast a specific range of opportunities where breakers are more likely, turtle soup runs on stops as entries. Okay, some of you are afraid to buy sell stops. Well, when you understand this hierarchy and how it works within a range and how you can grade price swings using a draw on liquidity, okay, you're using bias, you're using algorithmic order flow, and you put all of these things together. Notice that I did not bring in commitment of traders. See that? I have not rung in interest rates. Notice that. Notice also that I have not brought in anything except for the very things I talked about here. And I still framed an entire price run and forecast exactly where these moves would potentially form. That's repeating phenomenon. That's how you know that these things are controlled. It's delivered with a program that is engineered to do things repeating over and over and over again. There's slight little nuances that you need to know, otherwise you won't pick up on it. And this stuff happens all the time, and it's been happening. Before everything went electronic, manual manipulation would take place around these levels. Men would sit around and control price. It sounds contrived. It sounds nonsense. Everybody out there is shaking their head that's been trading for a little while. They're like, there's no way it was like that. It only started when it became electronic trading. No, it's been like this forever. Forever and ever. Since they started speculating, it's always been controlled. It's just like the casino. They got to let some people win. Okay, that's a given. But the majority lose. That's the game. So once you know how they stack the deck, and when they run the table out, you can bet only when it's likely to happen. But notice I said when it's likely to happen. That's not the same as saying you're going to win because this is what's going to happen. It's just a probability thing where without these signatures in price, there's no way I could know what was going to happen. And I would fail miserably every single week with you. I would be failing every single week to be able to tell you what the market was going to have delivered in our charts. But you see the opposite of that, because I'm using the things I'm teaching you here, and I'm leaning on these things. Now, if these things were not true, if they were not algorithmic, if they were not absolutely controlling price, then I would absolutely be the luckiest person on the planet, and I don't believe in luck. So if I could not see these things, I would be failing miserably. You all would have unsubscribed. You would have said, this is it. I don't need to say anymore. This guy doesn't know what he's talking about. But the opposite is what you see here. I'm presenting the evidence to you. Now, do you need to subscribe to every little pip fluctuation is controlled and manipulated to be profitable? No. And that's what I'm trying to show you here. We're only looking for those choice little setups where everything just makes perfect sense for it to occur. We're not looking for everything in my arsenal to be speaking at the same time. We're looking at specific things that must be there. What is that? Things like I'm showing you here. If I'm not looking at a market maker buy or sell model, I'm looking at graded price swings like this. That right there is another thing I just laid heavy on you. I'm not always trading in a market maker buy model or sell model. Sometimes I'm looking at just a simple price run on a liquidity basis, and I grade that price swing like I'm showing you here. And those are the only two pillars of my trading. That's it. Why is it just those? Because that's how these markets book. That's it. And if it doesn't make sense, or I can't see it, if I can't connect with it and see, okay, this is what I'm supposed to be doing right now, I'm not doing anything. And I know why I'm not doing it. And guess what? I'm content. I'm absolutely content with not doing anything when I cannot see a market maker buy model or a market maker sell model or a one-sided price run to liquidity like what this is here. Light bulbs are going on, aren't they? This is going to be enough for this video. But I want you to just know that if this is the first time you've been introduced to this idea, it's taught deeper in the content. Okay, just trust me, it's there, and we will dig more into it in charter membership. But I hope you all had a very pleasant and warm Christmas holiday, and I will tell you that we will talk again, obviously, on Wednesday. I'll give you some more teachings, and then I'll probably have next weekend's lesson up by Friday just to make sure I have it before the end of the year. Charter members, your last two model trade plans will be up before Thursday. Promise, Scouts honor, it will be done. It's the holidays, and it's just been one of those things where I just haven't been able to sit down and do what I need to get done. But it'll be done before the end of the year, and I will have made good on my promise that the 12 trade plans will be delivered over the course of 2020. And then we go into algorithmic theory for the charter members in 2021. And that, my friends, is going to be it. If by chance you don't watch any of the recordings next week before the turn of the year, Happy New Year. Be safe. And I will do my utmost and best to make sure that 2021 is an enrichment in your understanding and in your learning. Until I talk to you next time, be safe.